Hey everyone, welcome back to Smart Dollar Mindset, the channel that helps you build smart financial habits and unlock true financial freedom. In today's video, we're going deep into one of the biggest debates in the investing world: dollar cost averaging versus buying the dip. Which strategy builds wealth better over time? Which one is more practical? Which one fits your personality and your goals? We're going to break all that down, step by step, with real-world examples and the mindset behind each. So grab a drink, settle in, and let's get into it. What is dollar cost averaging, DCA? Let's start with the basics. Dollar cost averaging, or DCA, is a strategy where you invest a fixed amount of money at regular intervals, regardless of what the market is doing. So let's say you invest $500 every single month into an index fund. One month the market is up, one month it's down, another month it's sideways, but you invest anyway. No trying to time the market. No waiting for dips. Just consistency. The beauty of DCA is that you remove emotion from the equation. You're not watching the news thinking, should I wait? Or, should I buy more? You just keep going. Over time, you buy more shares when prices are low, and fewer shares when prices are high. That's how you average out your cost. It's like going to the grocery store every week with the same $100. Sometimes steak is on sale, sometimes it's not. But you always bring the same amount of cash. Over time, you still end up eating pretty well. What is buying the dip? Now let's talk about buying the dip. Buying the dip means you're holding onto your cash and waiting for the market to drop before investing. The idea here is that when stocks are on sale, you get more value for your dollar. For example, if the market falls by 10%, that might be your signal to jump in. If it crashes by 20%, maybe you invest even more. In theory, this sounds smart, and sometimes it is smart. You're capitalizing on fear, buying when others are panicking, and scooping up assets at a discount. But here's the catch. You need to actually know when a dip is happening, and even more important, when the dip is over. And timing that consistently? That's incredibly hard, even for professionals. Plus, what if the dip never comes? Or worse, what if the dip keeps dipping? That's how people end up paralyzed, sitting on cash for months, sometimes years, missing out on growth. Real example. Side by side. Let's say you have $6,000 to invest this year. If you're using dollar cost averaging, you might invest $500 every month for 12 months into something like the S&P 500. Over the course of the year, prices go up and down. But you keep investing monthly. Let's say, for example, the S&P starts at 4,000 and ends the year at 4,200, with lots of volatility in between. With DCA, you'd have bought during the lows and highs, averaging maybe 4,100 per share overall. Now if you were buying the dip, you might have waited for a 10% drop. Let's say when the S&P fell to 3,600. You deploy all your $6,000 right then and there. If the market rebounds, you win big. If the market falls another 10%, your investment takes a bigger short-term hit. The upside is that, if timed perfectly, buying the dip gives you better returns. But the keyword is, if. That's a big variable. Most average investors don't have the timing skills, discipline, or emotional stability to wait, and then act, when things look scary. Pros and cons. Dollar cost averaging. Pros: takes emotion out of investing, easy to automate, reduces the impact of volatility, perfect for long-term investors, fits well with salaried income. Dollar cost averaging. Cons: might miss out on better returns if market goes up consistently, slower to fully invest lump sum, buying the dip. Pros: potential for higher returns if executed well, allows strategic use of cash reserves, makes use of market psychology, buy low, buying the dip. Cons: requires timing the market, high emotional risk, fear of buying too soon or too late, easy to sit on the sidelines too long, may result in holding cash during bull market. Here's the thing. Most people think they're buying the dip, but really they're just market timing, and that almost never ends well for the average investor. Psychological angle. Let's talk mindset. Dollar cost averaging aligns with discipline. It's for people who want to build wealth slowly, methodically, without the stress of trying to outsmart the market. It's great for your mental health, because you're not second-guessing every decision. Buying the dip, on the other hand, requires confidence, patience, and sometimes a strong stomach. You have to be willing to go against the grain, to buy when it feels scary. And you have to trust that the market will recover. That takes mental toughness. It's not for everyone. And even seasoned investors can get it wrong. So ask yourself, are you someone who wants to sleep well at night with consistent investing? Or are you the type who likes to make bold moves when the rest of the market is panicking? Neither is right or wrong, but they are different personalities. Historical context. Let's look at some history. During the 2008 financial crisis, people who bought the dip in early 2009 saw massive gains. But during the fall of 2008, the market kept crashing for months. Many who tried to buy the dip in October watched their investments fall another 20% before the rebound. Meanwhile, people who stuck with dollar cost averaging through the entire 2008-2009 downturn ended up buying at every price point, including the bottom. And by 2013, they had completely recovered and then some. In the COVID crash of 2020, the dip was sharp and fast. If you caught it in March, you made big returns. But if you waited just 1 week too long, you missed the low entirely. That's how tricky it can be. Over the long term, markets go up. And over 30 years, the average return of the S&P 500 has been around 8%, 10% annually, no matter the short-term dips and crashes. What does that tell us? Consistent investing works. Timing can work, but it's far riskier. So what's the verdict? If you're just starting out, or you don't want to stress over market movements, dollar cost averaging is your friend. It helps you build a habit, it keeps your emotions in check, and it works well with steady income. If you're a bit more advanced, have cash set aside, and enjoy staying on top of market trends, you might consider buying the dip, but with caution. And ideally, combine both strategies. Here's a smart hybrid approach. Use DCA as your core strategy, investing regularly no matter what, and when major dips come, you deploy some extra cash. That way you get the best of both worlds. At the end of the day, building wealth isn't about being perfect. It's about being consistent, staying invested, and letting time do its job. If you found this video helpful, hit that like button. It really helps the channel. And if you want more smart money tips, make sure to subscribe to Smart Dollar Mindset. Now tell me in the comments, are you a DCA investor or do you prefer buying the dip? Let's have a conversation. Thanks for watching, and I'll see you in the next one.